Hello. And before we get into today's episode, I just want to give you a little heads up. Today, I've invited our Wonder Woman broker, Louise Lucas and James, her son and head broker, to come and talk about a loan that's been prepared specifically for renovators. Um, it's called the bullet loan, and I really want you to take notice of this because this has been developed specifically for people who flip. Now, a few of you are in that category, and so listen up. And if you would like to find out whether this is going to work for you, then you can find Louise's details in the show notes and give her a call and have a chat. She'll also talk about what's happening with interest rates and one of our favourite topics, renovating as a self-employed person, how you get your loan. So that's it for today. So enjoy.
You're listening to the She Renovates podcast. You're listening to She Renovates, the podcast for women who want to renovate to create an income and a life they love.
Welcome, Louise and James. I thought it was time that we had a little bit of a chat about what's happening in the world of finance, and you guys are the legends. So welcome. So I know that you've been talking about some changes in products available and so on. So I would love for our renovators to hear about those changes.
Super. We have lots of exciting news to share. But first up, we thought we'd tackle your other question first, which was on interest rates.
Yes.
And I've got this new, vacuum that does its thing, and it's busy walking its way around the room here.
It's amazing.
But it does pick up all the dog hair, so that's awesome. But anyway, so on interest rates, interestingly, even this morning, I'm getting emails, and James, we get flooded with emails almost every day from lenders. But today they're offering like fixed interest rates for owner-occ at 5.55, and you're sort of thinking, wow, that's super cheap from what's on offer. But the reality is, we're thinking rates must be heading down if that's.
So what we're seeing, I'll take over from here. What we're seeing is because receiving fixed interest rates around the mid fives, it's an indication that the lenders are expecting the interest rates to go down. Now, we've heard from numerous economists in the industry at the moment saying, oh, it's going to be February, it's going to be March, it's going to be later in the year, closer to August, November kind of. In reality, no one really knows when interest rates are expected to fall, except there is an expectation that they are going to fall. People think that these fixed rates are amazing, and for a lot of short term, they can be. However, fixed rates are a good indication of where rates are going, but they're not always a good indication of when you should be applying for a fixed rate as well, as to keep that in mind, as banks typically do win out on fixed rates. Here in Australia, we very much variable rates can give you a lot more push and a lot more leniency, especially with certain discounts that brokers like Louise and I can get you to any of your lovely renovators, but also any of our other clients. It's an indication of where rates are going, and to be keeping aware of it. And if you are interested in what your fixed rate is do reach out to Louise and I, because we can do some pushes. Even Louise and I are getting high fives at the moment for some owner-occ rates that I've been managing to get. I've even got some very competitive interest rates for investment properties that are tailored towards owner-occ interest rates. So really, there is a lot of push that we can get you, but there is an expectation that rates will start to drop soon.
But
right.
Also, long as we hope. But one of the commentators, try not to listen to the media and try not to have your hopes fixed on that, because they just love a headline and they're just putting out crap for the sake of it. So avoid that sort of stuff. One of the most respected commentators, Noel Whittaker, he said he doesn't think before August and maybe later. So just don't hold your breath on rates. And if you see some really keen fixed rates, maybe you might say, well, 1 year I might be prepared to fix, but be wary, because when they start coming down, you're sort of hoping that, but who knows? No one knows. So, and if they're telling you they are, they wouldn't be working for a bank as an economist, seriously.
No, that's right. And so can I just ask you, I know that you spent many years in the banking system, Louise. When the banks set their rates, let's say when they set their fixed rate, are they operating on any concrete information? Do they have any?
They have huge amounts of information, but it also is dependent on their actual book. So the amount of loans they have at a certain level, they might say, well, we'll offer this fixed rate to lock in a certain amount of money that we've been able to borrow, and we need to sell it at this rate. So it's not necessarily all to do with what the RBA is setting and what's the cost of funds. It's also how they're managing their own loan book.
Okay. So what
understand
that could mean is you, like James is saying, is getting some really good rates for some investors. What that could mean is that you may not have to wait for an interest rate rise to actually, interest rate reduction to actually get a better interest rate.
No,
To use the bank's lingo in that one, it's all about appetite a lot of the time. So we have BDMs across all our lenders that we communicate closely with when we're applying for clients' loans and working through the scenarios with our with the banks. So when we approach a lender, we'll contact our BDM, and sometimes we'll even ask, like, what's the appetite at the moment? Are you looking to price at this rate? What can you do for us here? Can you get some fees waived as well? So we're trying to get discounts across the board, not only just the fees, maybe the first annual fee we can get waived sometimes, if not just get a reduction in interest rate. And then again, some lenders will turn around to us like, we don't really have the appetite at the moment, we won't be pricing. But they'll still try for us. Like they're always willing to try, but sometimes it's a bit of hard push. And then we just say, look, these are the rates that we're offered, and we'll go to our clients, as many of your clients will have experienced with us already. We give a selection and we say, these are the options, this is the pros and cons for each one, and these are the rates and what they mean as far as your repayment goes, buried fees, the type of loan that they're after. There's all these options there.
Okay, thank you for that. That's it's a good sort of understanding of how things work. Now, we are going to get into the new products, but there was something else that came up that I think is probably worth clarifying, and we've talked about this before, but what is the situation if someone is self-employed and they're relying on their accountant to support their application? How does that work?
Oh, really easily now. Although we've had, variety of different low doc options over the years. At the moment, you can rely on your self-declaring your income plus an accountant's letter. And often the accountant only has to say they can meet the repayments. They don't even have to verify your income. So that's a pretty easy option for most accountants. Can say, yeah, I can see they can make them enough money to pay that loan. So yeah, I can sign off on that. So it's a very easy push for the accountants. But I laugh, the lender will often send a letter and say, fill this in for us. And some accountants will cross stuff out and I go, no lender is going to accept you accountants crossing things out. That just doesn't happen. So let's get something where we can meet in the middle on, what you're trying to say. But with the low doc loans, we can do it a couple of ways. One, with the accountant's letter. Another way is just sharing your BAS statements. Say you've had a much better year this first half of 2025 financial year compared with your 24s. We can actually just use your BAS statements and say, here's your BAS. And we haven't, or even if you hadn't finished your 24s, hadn't completed them, we can use the BAS statements from the previous year just to show consistent income. And they'll review your business transaction account. So they're just checking that you're making money, which is fair enough. And that's pretty easy to get a low doc loan nowadays with those sort of options. But you have to have been self-employed generally for 2 years, or have at least held an ABN for 2 years. So you can be new to the business. Some lenders are less, but most are as much as that.
I just wanted to clarify a few points there. So yeah, absolutely with the BAS statements, we do also need to see previous statements, and we may present that to the bank, but only use your BAS as far as verification of income. So it's good to have across the board, what we can see is proof of where the trajectory going. And then if there is, say you've doubled your income in the last, in this first half of the year, we can actually tell the story as to why that's happened. Say, for example, you've expanded, you've got a lot more inventory, you're moving product a lot faster, you found some new marketing strategy. Whatever the story is, as long as it makes sense, we can generally justify it to a bank and get you that higher level of lending with a higher income. But the main thing for all self-employed people to really keep in mind is you just got to be really friendly with your accountant and make sure they like you. Because the more your accountant likes you, the more they're willing to help you out when it comes to lending and helping us get you that loan.
Yeah, that's yeah, I get that. Yeah. We've had a few situations there, haven't we, Louise?
Well, we have, but
Where
we get
Louise
there, don't we?
Pardon?
We get there in the end, though.
Yeah,
We
yeah.
always do.
Louise has had a few come to Jesus moments with accountants. So yes.
Yes.
Anyhow, yes. Okay, so let's talk about what's new in terms of product.
Oh, great. Can we do, first of all, I just want to talk about what's not new and what's old. And James, we've been talking about people are often coming because they want to have a line of credit. And we understand the desire because they were a great loan 10 years ago, and they're so handy and they're so flexible, and they used to be the same rate as your owner occ or standard variable. They were fabulous. You could do anything. But nowadays, because so many people didn't pay any debt off using these loans, and 5, 10, 15 years later, they're still in the same amount of debt they always were, ASIC has made the banks charge a lot higher premium for using them. And so we tend to avoid using these loans now. In fact, low doc loans, standard variable low doc loans, are actually cheaper than someone full doc getting a line of credit.
Wow.
So lines of credit are often even higher than SMSF loans. So go there.
Wow.
So it just tells you really that the banks are trying to avoid using them. And so people often come to us and say, oh, I've been told by my accountant, I've got to get a line of credit and blah, blah, blah. Go, that was like 10 years ago. That was a great idea. But nowadays, if you can go full doc, we'll get a standard variable loan. We can do 5 years interest only. And then in the 5 years' time, we'll revisit it. But 5 years interest only virtually gives you the same thing. You have the loan, you have your money in your offset. You're not paying any interest unless you're using the money. You can put the money in and out of the offset account. No issue. So I just want to talk about that as an option for people, because people will often think, oh, you're just not giving me what we want. But the reason is because it's not in your best interest. And we have, as brokers, a best interest duty, which the banks don't have, by the way. Brokers actually have to act in your best interest. And when we know those loans are really expensive and not really fabulous for you, we tend to avoid putting you in them.
Yeah, that makes sense.
Yeah. James, have you got anything to say on that?
Yeah, I was going to say, keep in mind with the line of credit, a lot of the times you do need a security to hold the line of credit against. Say, for example, for renovators, I would assume maybe $200,000 would be fantastic 10 years ago in a line of credit. And being newer and line of credits being what they are these days, as I've been introduced to broking over the last few years, that sounds like a fever dream back in the day when they were fantastic and they worked exactly how they were. But now it's more detrimental. There are higher fees involved. The interest rates are a lot higher. And overall, if you look to a lifetime of the loan of what you're going to be using it for, they no longer make financial sense. They're going to cost you far more than taking a standard variable interest only loan, using that for your renovation and your purchase, and then paying that off as you sell the property. And then you can restart and go from there. That makes more financial sense long term if you're going to be continuing to gain money in this with renovations, rather than having a revolving line of credit, because one, that needs to sit against the security. So you need to keep trying to find somewhere for that to sit against, and you have to move that before you can sell. Secondly,
well, hopefully we can put it against your home. That would be the aim, so we don't have to move it. We just leave it there.
Yeah,
and
exactly.
I know that's probably what they're thinking in the first, case. Yeah.
I know a few clients though who don't have it again. They just want to buy, live in, sell it, and move to the next one, live in and sell. And that's not going to work for a line of credit, for example. And these are the scenarios you got to keep in mind as well.
Yeah,
that's true.
Yeah.
Yeah, and we also wanted to talk to you about bullet loans. Is a new loan offered by one of my lenders that is specifically designed for renovators, and I love this. This could have many options for people. So they actually capitalize the interest, and there's no servicing required. So if you don't have income to service, you can just use this loan. It uses residential and commercial securities. The loan term is from minimum of 6 months to a maximum of 2 years. It must be unregulated, so regulated loan. So that means that it must be in a company or a trust. It cannot be in personal names. They have to have a clearly defined exit strategy. So the exit strategy will be usually selling and flipping the property, which is fine, which usually you don't want to tell lenders that, because, it can be, they don't make any money on loans that are short term. So this is specifically designed for this purpose. The maximum loan to value ratio is 75% in residential and commercial, but only 70 on vacant land. The loan size, the maximum of 8 mil, and there's...
Did you say 8 mil?
Yeah. So there's plenty you can do with it, and especially with someone who, like, say, for example, like yourself, Bernadette, who made a living in a company that is entirely based on flipping. This is an ideal loan scenario going forward. To think of the opportunity you can have, and especially with the lack of servicing, you could have, say, multiple projects on the go with such as a bullet loan. You can do multiple things at the same time, because it's not so much dependent on the servicing, it's the capitalized payment at the end, which is where these bullet loans make their money. So really it is a win-win-win for yourself, the flip, and the lender, because it all lines up with the goals that you're trying to achieve.
You're paying the fees, but your interest rates are actually starting, depending on your scenario, 8.79. So they're not even like a private lender at 12, 14, 16%, which is even major lenders are lending, unsecured lending at that level. So they're actually pretty good rates for what you're getting.
So how do you secure them? Like, what's the security?
The new purchase.
With the property, yeah.
With the property that you're actually flipping.
Okay. That is amazing.
Yeah, I know. I think it's great.
I hope all my students are listening to this.
So I think it's a really, there are some cheaper low doc options which we can do, but it depends on how bad your servicing is. And it's still cheaper. If you're doing private lending, you're generally looking at over 14%. It's a minimum,
And also the fees in private lending do catch up with you very quickly. So as much as private lending can be an option, they are vastly more expensive than these kind of options that we can look at for people.
But also, we've just got to say, it's not necessary that you will get that 8.79, but that's where they start. And it's possible. It's in that range. It's in a lower range because they're specifically designed for this purpose.
Well, that was definitely worth scheduling the episode for. Amazing. So what would be the scenarios when someone wouldn't be able to secure a bullet loan?
If they do not have a company or trust that they're purchasing the property in, so they need to have, and it is not a trading company. The company is for the purpose of, buying the property. So you can't just use something you've had. Preferably you've had your ABN and for a while. So whatever you're using, that way. And this is your main line of income, that would be really positive for the lender. They would prefer to see you've done something. So usually people can do a first project using their home equity and then purchasing. But then they get slowed out because they're not, and often they'll count that not as income from the project, but it'll be counted as, whatever, an investment and blah, blah, blah. Anyway, that's the accounting side of things. But on this loan, this becomes your job. It's the flipping loan, really. Anyway.
And then
that
it's
is
company,
extraordinary.
which is the main thing. So it is an income. It is a profitable income from the property. Yeah.
Well, anything else?
If you don't have any cash to put in, then you're stuck. So people sometimes come to us and say, "Oh, can you borrow the whole?" I can borrow 100% of my bank. No, you can't actually. What you're doing is your bank is using your own home as the security.
Cross-collateralizing.
Yeah, exactly. And they're just not telling you. So don't lie to yourself and me, because that's simply not true. There are no 100% lends anymore. You have to put some cash in. So into these projects, they want to see. So anyone who's got a good, a reasonable chunk of cash sitting here, to go and do one of these can be a good way to increase that.
Amazing. Absolutely amazing. And I'm thinking for the class project.
It's possible,
because we'd only have to raise the deposit, which, that really opens up lots of options.
Yeah.
Yeah.
And you have to have a project for, well, it depends who owns it. So, but yes, for yourselves, it's definitely a possibility.
And the requirements are just you have your cash backing as a deposit. Remember, it's 75% plus purchase.
And your renovating costs. So you
And
need
your
to have
renovating
a bit more cost, and your stamps and all that sort of.
You need the cash behind you to afford these kinds of loans, but once you're in, it's definitely a tool that can be used to accelerate your flipping as a full-time income. Just keep in mind that as much as we're saying, it's 75% of the property, keep in mind you have to make up that 25% plus stamp duty, plus fees and everything else, and then your flipping costs on top of that. So for first-time flippers who are just joining, this isn't probably the loan for you. You'll probably something that we often do, which is an equity release and purchase. So we can get you the deposit plus fees, stamp, etc., and your money for using it for a flip, and then your purchase on top of that. This is someone who's been in the game for maybe 1, 2, 3 flips and knows what they're doing to get moving.
Yeah.
And also, Bernadette has a brilliant feasibility worksheet. So don't do this without doing the work.
Yeah, absolutely.
This is what I find. People come to us and they really haven't used all the tools you're offering, which is just insane. Yeah. Just go through and actual do the worksheets. God, it'll save you in the long run, enormously, because it actually just is a tick the box program. It's so handy. I love it. But anyway, I like figures. So those of you who are avoiding the figures, just do the work and you'll find it good.
Well, look, to be honest with you, I hate bookwork. I love numbers, but I hate bookwork. So that's why I have 2 versions of feasibility. I have one that's very, very detailed for those people that really love that level of detail. And then another simple one, which is the one I use all the time, easy to do. And shortcuts are the bane of my life.
Yeah.
But anyhow, so that's really great, because I think, I actually think I could use that.
Good.
Oh, absolutely.
Help you. No problem.
Beautiful.
So just call us. Check out the website, anyone who's watching, at propertyed.com.au. And we're keen to help.
Well, thank you so much for coming. That's short, sharp, and very actionable. So I love it. So thank you. We have delivered on the brief. And
more than happy to help.
Fantastic. Thank you very much, Bernadette.
This is the She Renovates podcast. To discover how to harness the power of renovating, check out theschoolofrenovating.com.